this recording and we move on. All right, so we are riding on to chapter number 4, and that is universal life. So you see now it's important to go watch the earlier class that where we treated chapter 1 to chapter 3, because this is more like a continuation. Okay. So universal life, as we learned from earlier class, is a permanent insurance. All right. Again, like I mentioned during our morning class, the idea of the objective of this class is not to go read line by line, but areas that I feel are important, I'll give you guys a nudge on those areas, and then we will go through it in details. But areas that I feel you guys could go read that up on your own, please, I'll let you know, and feel free to go ahead and do that. Okay. So we're going to see a lot of dates when it comes to universal life. So let us prepare our mind for that. And this morning during the class, I recommended they need to have a note to jot down, some of these important information. If you have a note somewhere lying around in your house, you want to quickly grab one now so that you can use to take notes, write down some dates, write down some key words and abbreviations. Okay. Now, policies issued prior to January 1st, 2017 have been grandfathered, vested rights surrounding tax advantages will be maintained. Changes to these policies, this doesn't feel like we are starting from the beginning, but we are. So why does it feel like I was expecting to see first what is universal life, right? Huh. Anyways, one thing I want you guys to know that universal life is a permanent insurance. So as we saw this morning, there are 3 types of permanent insurance. There is whole life, there's 10 to 100, and there is universal life. Okay. Now they are giving us a key date. Now this date is very important. Okay. Policies issued prior, that is before January 1, 2017, before January 1, 2017. You see, again, for me, when I was doing my exams, I look for a, a key event that happened in my life around these dates to help me remember this particular date. Okay. So these policies have been grandfathered and vested rights surrounding tax advantages will be maintained. Changes to this policy might affect vested rights and should be carefully considered. So they have given us a key information here. There are some tax advantages associated with a universal life that have been in existence before January 1st, 2017. And why are they letting us know of this? Because sometimes we come across some old policies, so we don't get overexcited to tell the client, oh, I can get you something better. Oh, I can. No, because when we change any of those grandfathered policies, they are ripped of their rights. It means the owner lost some of the tax benefits that are associated with those policies. And we are going to see as we continue in this class, okay? Transparency through unbundling. Universal life insurance combines life insurance with tax advantages. Okay, so now they're beginning to tell us benefits of universal life. Okay, there is an advantage because you see, universal life is that policy that we can combine term insurance and critical illness and universal life all in one plan. Okay, policyholders do not pay premiums, they make deposits to the policies. Deposits go into an investment account. That account pays anytime I move this thing, okay? Um, deposit goes into an investment account, and that account pays expenses and is the source of funds investing. Okay. Now, let me see here. Sorry. It's because of the way I blew up this. So when it moves to the next page, okay, can you guys see it properly? Can you still see my screen?
Yes. Yes.
Okay. Okay, this is better. I think I blew it up, and then moving to the next page, I don't get to see a lot. Anyways, so there is here what we call transparency through unbundling. Now, universal life insurance combines life insurance with tax-advantaged investing. And why is that so? And that is so because policyholders do not pay premiums. They make deposit to the policies. Okay? Deposit goes into an investment account, and that account pays expenses. And that account also is the source of the fund for investing. You see the difference, right? Because when this money, when we look at whole life money comes in, is placed into the cost of insurance, and then the other one is go into an account called a side account, right? From where the money invested, because the policyholder does not have control over that side account on how it's being invested. But look at universal life is different. Universal life had that transparency through unbundling, in the sense that the policy owner is involved in how the investment strategies are done. And that is why when money is paid into the account, it's referred to as deposit. Okay. Now, there are three factors that determines the premiums for all forms of life insurance. We've looked at the factors earlier in the morning, right? We looked at mortality cost, we look at administrative expenses, and then we look at investment income. In a whole life policy, these three factors are bundled together. They are not separated. The policyholder does not know how much of the premium paid gets applied to the life insurance premium, right? And then get applied to which cost or expenses. However, in the universal life policies, there's a revelation of how each of these three cost factors is calculated and how they apply to the individual policies. First, universal life policies provide transparency since the information is openly disclosed, and unbundling since the factors are clearly separated from each other. So policyholders can better understand their policy and its cash value when they have this information available. So the cash value in universal life policy is the value of the investment account. You can see that this is pretty much straightforward, right? With universal life, there's transparency of how much money comes in, how much money goes into the cost of insurance, how much money goes towards premium, how much money goes into expenses, and how much money is made from the investment account. So that is a key advantage of having a universal life, that flexibility, that unbundling structure within the universal life policies. Then the next advantage of a universal life, or rather, I won't say an advantage, but I will say feature of a universal life, is the premium tax. Okay, contract Contracts and sales literatures refer to the amount that a policyholder pays into a UL policy as deposit and not premiums. So due to their role as both an insurance and investment options, however, for consistency, so I've lost mine. Okay, let me have the key. Mommy, I want to know how to Guys, I'm in class. You can have the remote. Okay, so we're talking about premium tax. Okay. We're talking about premium tax. Now, contracts and sales literatures refer to the amount that the policyholder pays into a UL policy as deposit. So, and not premiums. And due to their role as both an insurance and investment option, however, for consistency, we will use the term premiums to refer to them. So again, I want to see, to refer to them. Because in whole life, there is premium tax on premiums once they are paid. I want to see perhaps there is this premium tax advantage because the premiums paid into a universal life account is not termed as premium, rather is termed as deposit. Okay, so now let's move forward. The next point here is provincial tax. When you look at the provincial tax, between 2% and 4% is charged on all premiums paid into a UL policy. This premium tax reduces the amount deposited to the investment account and the remainder of which goes into the policy's investment account. The policyholder can avoid this premium tax by investing that same amount, that same money outside of a UL policy, for example, by investing in a mutual fund or GIC. Okay, now moving on to mortality charges. Now, as with term and whole life policies, the mortality cost for universal policy reflects, oh my God, this evening is. As with term and whole life policies, the mortality cost for UL policies reflects the insurance company's cost of paying out the death benefit that we see in the morning. All right. Now, the insurance company deduct the mortality cost from the investment account. And later in this chapter, section 4.3, we will learn that the policyholder has some choice around how the mortality costs are calculated. This is interesting. Okay. And then the third part of how premiums are calculated is what the administrative expenses. So the administrative expenses also of the insurance companies are its cost of doing businesses as listed here. And these costs are deducted from the policy holder's investment account as a percentage of an annual deposit to the account or as a flat monthly fees. Okay, it depends. It could be a flat monthly fee or on an annual basis, depending on the way the contract is structured. All right. Now, there are many investments from which the policyholder may choose details about investment, which are discussed in more details in the investment choices selection section. Okay, and then because the policyholder sees how mortality costs and the administrative charges are calculated, the policyholder gets a clear picture of how investments are performing. Okay, investment growth is tax-free, providing it is less than the limit set out in the Income Tax Act. And this will be discussed more in the exceptions section. All right. So we move on to flexibility for the policyholder. You see, all these things we are seeing are the components and the benefits/advantages of universal life. From the this morning class, we noticed and we learned that with whole life, all these unbundling structures does not exist. Why? Because the policyholder doesn't have insight into the separate function of these three components that drives how premiums are paid from the back end. But with universal life, we are seeing that flexibility being in existence. All right. Now, one of another of that is the flexibility for policyholder. Right. A UL insurance provides many options for the policyholder when the policy is issued and while it continues to be enforced. Changes can be made okay, to best suit evolving policyholders' needs. And that's so true. Because sometimes we may start, a client may have, I've had my client have this several times. Like maybe we just did a blended plan for clients where we have maybe 200,000 universal life, 300,000 term insurance, and then critical illness, all combined. But as the income and the capacity of that client increases, they may say, you know what, Joy, I want to convert the term to universal life, giving me 100% universal life. All those flexibilities are things that a policyholder can do with universal life. But with whole life, that flexibility does not exist. Okay? Changes can be made to best suit the evolving policyholders' needs. That's what I just explained. And then the following factors are all flexible, that is changeable in a UL policy. Number one is the timing and then the amount of premium. You see, with universal life, the policyholder can decide how much he wants to pay. That flexibility is there. Also, the face amount, that flexibility to choose that face amount is there. Then the lives or lives insured. You see, with universal life, we can insure two lives, okay, together with universal life. Okay. Um, let me see here. The life insurance. Then we move on to 421. Okay, the timing amount of premium, right? With specified limits, within specified limits, the policyholder can decide how much and when to pay premium. There is a minimum premium requirement and then there's a maximum premium requirement. So in between this, like some clients may like, okay, maybe their premiums every month is $200 and then the minimum may be $50, right? If they are going through some financial challenges, they can opt to be paying that $50 in the meantime. And then as soon as things bounce back for them, then they go back to paying their $200. So that flexibility of paying minimum and maximum is there, or somewhere in the middle, okay? All deposit goes into the investment account, and then the minimum premium pays the life insured mortality cost, and then the policyholders administrative expenses and premium costs, and is designed to keep the policy in force until age 100. Okay, but it's important to note something very important. Um, when minimum premiums is being paid, the amount is said to be minimally funded, as the minimum premium is not enough to build up the investment account within the policy. What I tell the client is, okay, if you are paying the minimum for now, don't expect to see your investment to grow, because you are only putting money towards cost of insurance and the administrative expenses cost. There's nothing going to investment. And the investment, like they say, is what you put in that will grow for you. If nothing is going to fund that investment account, you do not expect to see any growth from that account. Okay. The maximum premium respect the deposit limit in order to keep the policy tax exempt. So in as much as there's that flexibility to put more money into the account, there is what we call um, um, tax exempt strategy, exempt test uh, lead. Like it protects the policy, the contract from being exposed to taxes. So this maximum contribution needs to also be watched at closely so that we don't put too much money into the account and thereby expose the contract or the policy to taxes. Okay. Deposit flexibility is available between making the smallest deposit and making the largest deposit. This flexibility limits lump sum deposit and higher regular deposit to be made as desired. Okay, and also this premium deposit builds the investment account value. So when the account is more than minimally funded, it has more value than needed to pay associated costs. Okay, so all these are the benefits or the flexibilities that are associated with universal life. All right. Now, insufficient account value. Well, in their if the account cannot pay the mortality cost and policy expenses, then the policy collapse. Is it just like every other policy, be it a whole life, right? If the money in the account cannot fund the policy, then the policy will lapse, okay? Minimum funding, or what leads to that for the most part, like insufficient account value, can be as a result of, when people are putting, the minimum requirements. In that case, I tell them, look, when you are putting the minimum, this policy would not last long. And in that case, what I do as an advisor to protect myself is I go back into the software and run the illustration, keying in the amount they are willing to start paying. And then I tell them, this is how long you can pay this amount, after which you need to pay more, start putting more money, otherwise this policy will lapse. And I put it in their file, okay? So that tomorrow, if they come and say, oh, but the advisor did not tell me, I will have that document as an evidence to show them that, no, I told you that with your minimum deposit, your policy can only be enforced for X period of time. So we need to bear that in mind. Another thing that can lead to insufficient account balance is withdrawal from the policy. You see, when a huge withdrawal is made from the policy and there is no ongoing contribution, that can affect the account. And also few or no deposit to account. Sometimes people are not making deposit, or that will contribute. Again, if we read through that, we will see the impact of that. So let's move on to the modal factor for universal life. So how is the modal factor for universal life determined? For term insurance and whole life, um, and whole life insurance policies, the modal factors almost always reflect an interest charge that the policyholder must pay to the insurance company in exchange for spreading the premium out over a series of payments. For most UL policies, the modal factor is 1 divided by the number of payments per year. Okay, so now look at this modal factor as how do I put it to explain it? Let's go back again. Let's go back. I just want you guys to get this, okay? The modal factors for UL policies. For term insurance and whole life policies, insurance policies, the modal factors almost always reflect an interest charged that the policyholder must pay to the insurance company in exchange for spreading the premium out over a series of payments. What this is telling us is this. You see, typically the modal factor for every insurance contract is annual. Okay, so you pay annually. However, if you're not paying annually, there is an interest charged. There is an interest that the insurance company charge for spreading that payment over the longer period of time, usually every month. This is what this is speaking to. And for the universal life policies, the modal factor is 1 divided by the number of payments per year. So if somebody is paying every month, so the modal factor for the UL policy modal factor will be 1 divided by what? Number of payments, which will be 1 divided by 12. Okay, in that case, we will have, can somebody give me the answer? What is 1 divided by 12? Hello? You guys unmute yourself now. Have I been talking to myself?
We are here listening.
What is 1
Oh,
divided by 12?
mm,
1 divided by 12 is 0.0833. So that will be the Moto factor. Okay? Because in this section, there is going to be calculation. So I don't know
oh,
how you guys will be sitting down. Get your notebook. There's going to be calculations in this. And if you're still doing these small, small ones, and you guys are not involved, you're not writing, that's not encouraging, right? So
mhm,
therefore, the insurance company does not apply the model factor to this type of policy. For example, you guys read the example here. You can see that this times 0.088, that is the model factor. Okay. I won't be able to start going through this, but going through this is going to help us
okay.
with all the calculations. And that's why it's important that you guys go through this and practice the example. Okay. For example, this insurance company does not apply the model factor to this type of policy. In section 3234, an example showed a term policy with a model factor of 0.88, such that an annual premium of 956 became a monthly premium of this. And how is that done? You see, when they give you a model factor like this, all you just do is take the annual premium,
Mhm,
multiply by that model factor. So which is 0.8, they already give you the model factor. So when you take the 956 multiply by 0.088. So that is 84,128. So that is 84.13, to round it off. So this will be the monthly premium that this individual will be paying. And then at the end of the year, the premium that is supposed to be 956, the person will end up paying $1,009.56. And that's why even when you guys start running illustration for your clients, you're going to start noticing this. You'll see that when a client is paying annually, their premiums are cheaper compared to when they pay monthly. Okay? So now, calculated as this, which is 6% higher than the quoted premium of this. So for majority of universal life policy, the model factor for monthly payment is 0.0833, calculated as 1 divided by 12 model factor. For semi-annual policy, it will be 0.5, calculated as 1 divided by 2. Okay, in this case, the annual and annualized premiums are the same. Okay, so we move on to discussing face amount in universal life. Okay, now the face amount is specified when the policy is taken. So you don't take policy and then come back later to say, oh, by the way, the face amount. No, it's specified at the point of taking the policy. Okay, and the policyholder can add additional coverage to the policy in future, subject to providing evidence of insurability. If the policy has a guaranteed insurability rider, okay, which will be discussed later, then evidence of insurability will not be required. Okay, we discussed this morning about what is insurability and all that. So I'm sure if by the time you guys go through the class this morning, you play
yeah.
catch up with that. Okay. Now, um, let's see. Face amount we've talked about that. Let's insurance. Okay, now increases and decreases to the face amount of the policies are usually restricted to a minimum amount. That is an increase of 25,000 or decrease of at least 10,000 to minimize the administrative cost involved in making such decisions. So what this is telling us is that sometimes when people want to increase their policy or reduce it, there is a limit to what they can do around that due to the administrative cost involved in executing those strategies. Okay? Lives and lives insured. You see, one universal life policy can be used to insure multiple lives. I said that earlier. All right. Now, for a joint life basis, a single life basis, or depending on insurance company, sometimes both. Okay, we can have joint life that covers both combined, or we can have joint first to die or joint last to die, as we saw this morning with term insurance. We can also do that with universal life. Now, when we are talking about pricing the insurance component, the mortality cost deducted from the investment account of a UL policies are reflection of the net amount at risk and the mortality costing method used, which takes into consideration the following. Okay, so when it comes to pricing of the universal life, the net amount at risk, that is the NAA, whether the mortality cost is based on a yearly renewable term or whether the mortality cost is based on level cost of insurance. So whether the mortality deduction is guaranteed or adjusted. So now this is a new terminology they are introducing to us right now. And this is called what? The net amount at risk. So we're going to write that down,
NAA.
NAAR. Okay, so the net amount at risk. All right, and we're going to go into breaking this down as we go through these sub chapters. Now, the net amount at risk, the insurance company's risk in any policy is the amount that must be paid as the death benefit. So that is the net amount at risk. That is the amount that when somebody dies, the insurance company will have to do what? To pay
Okay.
to the beneficiary of that policies. Okay, and that is a function of there are several factors that drives this net amount at risk. The policy reserves that insurance companies built up over time decreases the net amount at risk. And the risk is called the net amount at risk is a universal life policy is equal to death benefit minus investment account value. So the
Hmm.
formula for calculating net amount at risk is equal to the death benefits less the investment account value. Okay, so are we following?
When they say the investment account value, that's how much what's the investment account value? How much the insurer has put into the investment,
So
or
yes,
how much the
that is the investment account value. But again, we're going to see there are different aspects of what drives that investment account value, whether it's level cost of insurance or the increasing death benefit or is level cost death benefit. All that we're going to see, and I'm going to break it down for you guys using that. Okay.
Okay.
Now, note that the death benefit in this formula refers to the full amount payable upon death. Therefore, the higher the value of the investment account, the lower the net amount at risk. Okay. And the lower the net amount at risk, the lower the mortality charge to the account. And the lower the mortality charge, the more the investment account can grow. For example, Patrick owns a universal life policy with a death benefit of 500,000 and an account value of 128,000. The current net amount at risk is 372, which is calculated at 500 minus the investment account. Now, this um, this net amount at risk, now we're going to see how it's going to different if yearly renewable term is used. Okay. Now, if we are using the yearly renewable term to calculate this, then the cost of insurance is expressed as a dollar amount per 1,000 of risk for UL policy per 1,000. Okay. So the mortality cost in that case will be net amount at risk multiplied by cost of insurance divided by 1,000. So that is if we are doing it based on yearly renewable terms. Remember, at the beginning, we saw it here that the net amount of risk can be determined using the following. Number one, the yearly renewable term, okay? And then secondly, level cost of insurance, and then whether it is a mortality deduction or guaranteed or adjustable, all that will come into play. So this first one we are looking at now is the yearly renewable term, and this is the formula for the yearly renewable term. And for this, we're going to see this in this example here. Suppose that for the current policy year, Patrick's policy had a cost of insurance of 18.57. And the insurance company will make a mortality deductions of 6,908 from his account, calculated as 18.57 times 372,000 divided by 1,000. So a policyholder can choose between two ways if applying the risk of death to the net amount of risk. Okay, so therefore, the yearly renewable term YRT costing, the level cost of insurance, and they are discussed below in section 4.3. So we're going to see them in details here. Level cost of insurance. Mortality costing based on a level cost of insurance is based on a premium for a T100. So basically, the level cost of insurance, you see, like we discussed in the morning, that the cost of insurance, it increases as one age increases. But with level cost of insurance, this level the cost of insurance at the same amount throughout the period. So it means that the cost of insurance that somebody is paying when they are younger, let's say they are 20 years, will be the same as the cost of insurance they are going to be paying when they are 50. All right. Now, for this to work, there is going to be a lot of calculations and statistics and data being used such that somebody will pay the same cost of insurance all through, regardless of their age. That is what level cost of insurance simply stands for. Now, if you take that understanding at the back of your mind and you come in here and apply it, knowing that mortality cost based on a level cost of insurance is based on the premium for T100 policies. Now, this morning we discussed T100. You understand? And then we noticed that with T100, the premium is the same for the individual all through, right? So they are telling us that this is based on a T100 policy for which premiums are guaranteed to remain level for life. And the amount at risk remain constant, and the risk of death is spread evenly over the duration of the policy. And for a universal life policy based on level cost of insurance, the cost per 1,000 of risk remain constant over the duration of the policy. Okay, I know it's a lot of big words, a lot of stuff, but once you listen to this again and again, so it's going to make
Yeah.
sense to you. Okay, now choosing between yearly renewable term and level cost benefit. Now you've understood what level I've talked about. Level cost benefit. Now that is the cost of insurance is the same all through, right? But this other one is yearly renewable terms. It means that it renews every year. Therefore, the cost of insurance increases every year as the person age increases. Okay. Now, why do we choose which one over the other? Why choose level cost of insurance or yearly renewable term? Well, here are the things, information you could arm yourself with that will help you make that decision easily. Okay. The cost of insurance under the yearly renewable term is lower in the earlier years than the cost of insurance for level cost of insurance costing. We've established that, right?
Mm-hmm.
Yes, we've established that. Then we move on to the lower cost under yearly renewable term means lower deductions from the investment at the beginning, the investment account at the beginning, and therefore less is paid for mortality charges and more money remains in the investment account to allow the investment to grow in the early years of the policy. Therefore, a younger policyholder is well served during the early years of his policy by yearly renewable term costing because his mortality cost is low. However, in later years, mortality charges can be high, can be quite high, and may erode the policy's cash value unless there are high investment returns to offset these high costs. Okay? All right. So that is that on YRT. So we move on to therefore the young YRT cost and low cost. Okay. In later years, mortality charges can be quite high and they can okay now. So investment. Oh my God. Why is this thing doing me like this? Okay. In later years, it was outside the higher cost. Now, YRT is a good choice if the policy owner, okay, let me see.
We qualify for long-term rates.
Okay, if the policy holder will qualify for a low term rate and he wants more of his deposit to be invested in early years of the policy. Okay, so when somebody is younger, then this yearly renewable term will really be good because they could see significant growth in the policy in the early years. So we move on to level cost of insurance costing. All right. So now with the level cost of insurance costing, mortality cost deductions are higher in the early years. That's true. And this means that there are higher deductions from the investment account and less premium invested, which can result in lower investment account value. In later years, mortality cost deductions are lower with level cost of insurance than with YRT, which will help preserve the policy's cash value. A switch from YRT to level cost benefit may be possible. The reserve going from level cost of insurance to YRT is usually not permitted. Oh my God. Okay. Okay, can you mute yourself, please? Thank you. All right. So now there is this table here that compares the level cost of insurance with YRT. All right. So again, go through it. Hold your calculator, hold your pen, and then do the maths. Okay. You don't read maths, you walk maths. Okay. Now, moving on to guaranteed versus adjustable mortality deductions. This is the third one. Remember, we talked about the three factors that drives the the net amount at risk when it comes to universal life. We talked about the level cost of insurance. We talked about the yearly renewable terms. And then the third one is the guaranteed versus adjustable mortality deductions. Okay. Now, US policyholders typically prefer the assurance of knowing exactly how future mortality deductions are going to be calculated. Insurance companies typically prefer being able to adjust the cost of insurance schedules to reflect their actual experience with mortality investment returns in administrative expenses. Agents should understand policies to determine whether the costing, okay, whether the costing, I've lost where I am. Agents should suggest you understand the policies to determine whether the costing schedules are guaranteed for life or subject to adjustment. Agents should also advise their clients based on this information. Okay, now we move on to open-ended restricted increase. Now, this is an adjustment in cost based on open-ended no limit to the amount of increase or restrictions. Most adjustable policies place a restriction on increase, such as limiting increase to 25%, 50%, or 100% of the original schedule, or a specified dollar amount. Well, to be honest with you guys, these restrictions or this particular guarantee versus adjustable mortality deductions, I don't even see it. Okay, because if I show you guys illustration software, what we'll see is level cost of insurance and YRT. This one is not there, so I'm not going to worry myself, but that doesn't mean it might not come out in the exam, but
Yes.
try to
Okay.
understand it. Okay, and all this
Okay.
open-ended whatever is not something that is a normal practice for us in this space. All right, now we move on
Yeah.
to benefit options. Again, like I explained to you guys this morning, when we talked about death benefit options, we are talking about different ways that policyholders or beneficiaries can receive their death benefits. Okay, there are two questions, two information in the chat. Quick question, please. Okay, okay. All right. And by the way, at the end of each chapter, we'll take coffee break and bathroom break. So never mind. So now, what are the death benefit options? The death benefit is another flexible option with universal life. There are varieties of death benefit options available with UL. But however, the most common ones are level death benefit plus
Yes.
account value, and that we generally refer to as increasing death benefit. Then we have level death benefit plus cumulative premium, and next is indexed death benefits. Okay, now each of these death benefits affects net amount at risk. Okay, there are three death benefit options we just looked at: level death benefit, then debt benefit plus accumulated fund, cash value, and then indexed debt benefits. And I want you guys to know that each of these debt benefits affects net amount at risk. Okay, and the mortality charge deducted from the investment account. Regardless of the option selected, the beneficiary receives the death benefit tax-free. Now let's look at level death benefit. You see, this one, I see this a lot, especially when I review policies that comes from Great Way. Okay, for those of you that are familiar with them, they typically promote IRP. Okay, and this is not to put any MGA down, but I'm just speaking to the experiences of what I have seen, right? Now, what is death benefit means is that, you see, you have a policy. And for us, especially for us Africans, the reason many people do permanent insurance is because of that growth of cash value there. You know that, okay, I can withdraw this money, I can invest this money, it's part of an investment, right? But what use is an investment whereby when you can withdraw the money, but it reduces your debt benefit? What does that mean? Mr. A have a face amount of life insurance of 500,000. Okay. And now this universal life is growing. Now there's 200,000 in cash value, right? Now, Mr. A can take this 200,000. But if he takes the 200,000, his beneficiary, if anything, when he dies, his beneficiary will only get 300,000. And that is why you see that with a level death benefit, the net amount at risk is always the death benefit minus the cash value. Now let's look at the example. For a level death benefit, the level death benefit is offered in one of two forms. A death benefit equal to the face amount, regardless of whether the life insured dies. For example, face amount is equal to 250, death benefit is 250.
250.
Now, a death benefit equals to the policy's account value when the account is worth more than the face amount. For example, the face amount is 250, investment account is 275, then the death benefit is 275. So you expect that if my account value is 275, that 275 is not going to be added to the 250. So it's either also these are the two, level debt benefit that we can see. Now, since the net amount at risk equal to the debt benefit minus the account value, under this option, as the account value grows, the net amount at risk decreases, and so too to the mortality deductions from the investment. So because of the decreasing net amount at risk over time, the level debt benefit option is the least expensive. So again, because of this situation, this level debt benefit is not as expensive. But you guys see what I'm talking about now, right? So it's not as expensive. But people don't know. They're like, oh, I get a quote and it's this amount. But what is your debt benefit? Your debt benefit might be level. So you see money growing in your account. Yes, it's money growing. Yeah, but it's not adding to your debt benefit. Yes, you can withdraw it. You take that money, it reduces because the growth in that cash value is reducing the net amount at risk to the insurance company. You see that, right? Now, the one I love, which I always recommend, is what? The level debt benefit plus cumulative premium. No, not cumulative premium, plus account value. It means that I get my 500,000, and if the growth in my account is 200,000, I get my total money is 700K.
Okay.
You get? So let's take a look at that. So the level benefit plus account value. Under the level debt benefit plus account value option, the debt benefit is the original face amount of the policy plus the value of the investment account. And with this option, the net amount at risk is level over the duration of the policy, while the debt benefit increases. So you see that the net amount of risk of this policy is equal to the debt benefit. All true. The growth in the cash value does not reduce the net
Affects the
amount of risk.
benefit.
The amount at risk to the insurance company to settle. All right? And because the net amount at risk remain level, mortality deductions will be greater and the investment account will grow at a slower pace than UL policy with a level debt benefit. You see
But
that? That
does it not also mean that the premium will be a little bit pricier?
with
Level
level debt
level
benefit
debt
plus
plus
fund.
account value. Mm-hmm.
Yes, it is. It is. It is. And did you see this last statement here? This is
The option
hitting
is
me
more suitable.
personally. It says, because, where is this again? Because net amount at risk remain level. This is talking about mortality deductions will be greater and the investment account will grow at a
That
slower
is slower.
than UF policy with level debt benefits. So the UF policy with level debt benefit is growing massively, but of what use to the policy owner if the growth is not going to be added to you eventually, right?
Yeah, yeah.
And now I see it's making sense to me now because I have reviewed policies where they will show millions and millions.
They're doing so well, but the payouts wouldn't is not.
Yes. This is interesting.
You can't win the
Wow.
system.
Wow. This is interesting. Hmm, interesting. Eh, like you see some things and then you now see, well, okay. Now, I'm sure many of you guys who don't know what I am, what the revelation of
Mm,
understandings I
mm,
am getting. This is
mhm.
really good stuff. You see, this option is more suitable for individuals who can deposit large premium in excess
Yes.
of premium required. Okay. Now we move on to level debt benefit plus cumulative premiums. So this one is not common. Okay. To be honest with you guys, the two that I see in all our illustration softwares is this level debt benefit and level debt benefit plus account value. So that is the two. This level debt benefit plus cumulative premium is not something that I have seen. But let's read it, okay? And it's good to understand it in case they are testing it in the exam. Under the level debt benefit plus cumulative premium options, upon the death of the life insured, the beneficiary receives the original face amount plus the sum of all the premiums paid. Really? And then the premiums are actually refunded when the life insured dies with this option. And this is typically the most expensive death benefit
Wow.
option. With this option, the calculation is net amount at risk is equal to original face amount
Increase
plus
cumulative
the
premium
cumulative premium
minus
minus
account value.
the account value. Hmm. Wow. This option reduces the net amount at risk quickly, and the mortality cost deductions are reduced, which allows the investment account to grow at a faster pace to the extent that the investment account exceeds the original face amount plus cumulative premium, and the insurance company keeps the excess amount. Can you imagine? So this option ensures that premiums are not forfeited by the policyholder if the insured dies early in the life in the life of the policy. It is most suitable for individuals who plan on maximizing their premiums. All right. So we move on to the next one, which is index death benefit. Again, just a refresher. So we are talking about death benefit options, right? So we talked about level death benefit plus fund. Then we also talked about this one we just talked about death benefit plus accumulated premiums. And then the fourth one is this one, which is indexed death benefit. Now, with respect to index debt benefits, benefits this is the face amount index for inflation. Okay, so this puts into consideration inflation components. The face amount increases each year by the inflation rate, and Canada inflation rate are shown in this this inflation rate doesn't hold anymore. Our inflation rate now have gone haywire. So so it's no longer 2%. Okay, but at least we have that understanding. So the whole essence of this is that you see, when people take this policy, they want their death benefit to be indexed and edged against inflation. Therefore, when it's time, because like if somebody took a policy, like 20 years ago, right? And then that 20 years ago, 200K was a lot of money, right? Now, in their mind, that 20 years ago, 200K was a lot of money. But in today's dollars, 200K is no longer that much of a money again, right? So what that person from 20 years ago could do was to hedge this 200K against inflation rate, which enables this 200K to be increasing every year. So by 20 years later, maybe this 200 might be 250K, which is significantly more than what it should have been. So this is basically what this is speaking towards, okay? And each of these death benefit options, of course, have direct impact on the net amount at risk, okay? So if the account value is greater than the index death benefit, then the insurance company gives the difference between the two. Under this option, the net amount at risk and mortality deduction increase over time, depending on the index rate chosen by the policyholder. All right. So investment component is where we are going into next. All right. So what is investment component? Well, the following features are what makes a UL policy unique from other other sorry, from
Other forms of life
other
insurance.
forms of life insurance. Thank you very much. Okay. So now I love this part. You see, when I sit down with clients and I'm doing UL for them, and then we are looking at investment, and our clients are very amazing. Even when you do their KPI, stands for no know your client questionnaires, or we also call it investor profile. Is even when you've done their investor profile and their risk tolerance is conservative or very low, when they see investment performance records, they want the one that pays
Switch.
the
Mm-hmm.
well, I'm like, it doesn't go like that. You see, your profile says you're conservative, but you want to go with aggressive funds because you want to receive more money.
Show me the dollar sign.
Yes, they want to follow the money, but the interesting part there is that openness. You see, that involvement, that ability, that universal life, that flexibility, universal life, and the power it puts in the hands of policyholder, such that they can make and be a part of that decision. That's exciting to me. Okay. So that is part of what we're going to be looking at now. We're going to be looking at investment components with respect to universal life. We'll look at net premiums, tax deferral, investment choices, and impact of returns on policy viabilities. And each will be discussed in details. Let's go. So the next one is net premium. So what is net premium? A gross premium is the total amount of deposit or premium paid into the policy. But remember, the premium comes into, right? Now, but the net premium is the money that remains after the premium tax, then the mortality charge, and the policy expenses are deducted from the gross premium. So that is the net premium. Remember, say the money comes in, it branches into three, right? So you're going to have this imagination like this, right? You have gross premium. Don't worry, let me write it, I'll show you, okay? Then we branch out to three. Can you guys give me the three components? Premium tax?
Tax deferral.
No.
That's not it.
Mm-mm.
Companies.
Administrative expenses.
What's this called? I'm lost.
Then you have your mortality cost.
Mortality cost.
Okay. And then you have your what? Net premium, which will now go into investment. Okay. So can you guys can you see this clearly?
Is it no?
Hmm?
Yes, now.
So you have this gross premium, then you have the premium tax, it is reduced, removed from this. Then you have administrative expenses taken out, the mortality cost taken out, and then you have your net, premium at the bottom, right there, right? And it's that net premium that will now go into investment. All right. So now that is that net premium. We'll now decide, okay, where do we put this? Which investment option do we put this? You get what I'm saying right now? It's coming together, right? The net premium, okay, so and then therefore the gross premium minus the premium tax minus mortality charges minus expense deductions equal to net premium. That's what I just put together for you guys. You guys were not even looking at my screen because when I was asking you that time, the answer is right here.
Was right here.
Huh? Are you guys sleeping?
No, we're looking at but
Or am I confusing you guys? You see, I know it might look so daunting in a sense that these terminologies, it might be so new to us, but don't worry. You get this, okay? You get this. And the good thing is that I'm here breaking it down for you guys. After this class, go over it again. Go through your text. It will come together. Trust me. All right? It will come together. Now, the net premium is invested within the policyholder's investment account. You see, now in the UL, in the whole life, we did not have this kind of transparent breakdowns. Why? Because the money comes in, the insurance company manages everything, right? But this one now, we have this transparent breakdown and how the money comes in, and then this net premium is what we will now focus on, working on with the client. So the net premium is invested within the policyholder's investment account. As mortality deduction decreases the amount available for the investment, as the mortality deduction decreases, the amount available for the investment increases, assuming the premium paid remains constant. Okay. Now, so we move on to exempt. So now we've talked about net premium. So the next one now is what? Exempt test. So we understand the net premium right now, right? You should see the gross premium, then less all those expenses, then the bottom line is net premium. So let's look at exempt test. This exempt test is a fundamental principles that I want you guys to pay attention to and have a grasp of what it is, okay? One of the main benefits of universal policy is that it gives a policyholder a way to invest in a tax-sheltered environment. All right. But CRA being who they are, whenever there's anything that will make you to make as much money and pay less taxes, their nose will come poking. They will come like, how can these people be making this much money? Do you understand? So insurance company now came up with like a level to which a universal life policies can be sheltered from taxes. And then insurance companies say, okay, we know you are there, but we are going to do everything possible to protect our own customers, our policyholders, by creating what they call exempt test lead. So this is like, you see, when, for example, now I have this container, right? So if I put a rat inside this container, for example, the rat can only jump to the height of this lid and bounce back. It cannot jump through and go and hit the ceiling, right? So this is like exempt test. This is like a lead insurance company. It's like a Canadian mounted police. It's like a mountain guard on the gate between CRA and a policyholder's account. So this is like a gatekeeper. And here, I think that's a better word to use, right? So exempt is like a gatekeeper. And there's a sensor embedded in it that sends signals, okay, to the insurance company to let the insurance company knows that, this policy is growing so much. We need to do something before CRA will come because it's now sending red alerts. So that is what exempt test is. That is exempt test in layman terms. Okay. So one of the main benefits of UL policy is that it gives a policy owner a way to invest tax sheltered environment. A policy is tested annually to ensure it will be tax exempt. That is like gatekeeping, right? So see chapter 7 for more details on tax exempt on life policy, okay? And if the maximum net premium is exceeded, then the excess is deposited to the side funds of the policy. Investment returns in the side account will be taxable. So typically what the insurance company does is that when there's that kind of growth happening, insurance company can ask the client to come and take out some money, or they can put the money into a side account. And in that side account is totally exposed to taxes. Okay, so they can ask the client to, okay, don't put more money into the account or take out some money. All right. They say that we are going to deal more on exempt in chapter 7, but I think we've already breaking it down enough. Now, in today's world, the way exempt works for us as brokers is it's just a button. We just turn it on, okay, in the illustration software. So that is activated. And anytime you are doing policy for your client, make sure you activate that action, please. All right. But don't worry, I'm here. I will take you guys on field training, and you guys are going to see all these things I'm talking about. I'm talking about field training. One of the ways you guys are going to sink in these things you are learning here is to merge it with field training. Are you following me, guys? So,
Gotcha.
like, if any of you will book a field training appointment, let's say this week, or even for yourself, and I sit down with you and we do this thing, run illustration, all these things I'm explaining, the exemptors I'm talking about, the level debt benefit, the increasing, all these things, you will see it in flesh and blood, not in flesh and blood, I'm just exaggerating.
In
But
action.
you see the manifestation, okay? And then it will make a million sense. So this week, as we are doing this class, tomorrow we have class, no worries, but during the week, try book appointment or book for yourself, okay? I will share my calendar in our Telegram group. Go there, book me, take me out. Okay, you will learn a lot, and it will be a piece of puzzle that will connect all this for you guys. Okay, so that being said, let's move on to tax deferral. Income earned in a US policy investment account is tax exempt as long as the income earned remains within the policy's investment account, of course. Okay, and that is another reason why, some people say, okay, if you have this cash value, why won't you take it out? If you take it out, you might be exposed to taxes, but you can borrow against it. You can take a policy loan against it, and you will not pay taxes on it. And don't worry, all this you're going to learn as we continue. Investment returns may be reinvested, which leads to a compound growth and an increase in an account value. If the debt benefit includes the account value, then the investment growth may never be subject to taxation. You see that? You see? So
Yes.
if it's a cash plus fund, which is increasing debt benefit, so it means because once the debt benefit is paid and the person dies, there's no taxes at all again. And that's why some people, instead of taking that money and then be exposed to taxes, you understand, based on their adjusted cost basis, they just leave the money there. You understand? Then they'll just take policy loan against it.
Mm-hmm.
See? Then when they passes away, the beneficiary collect everything, pay off the policy loan, and then the rest is tax-free. Smart stuff. Smart
Yep.
stuff. Okay, let's move on to the investment choices. You see, the policyholder is responsible for management of his or her investment account. I love this part. And that is what I mentioned earlier, the flexibility that Universal Life gives the policyholder by them being involved. I love it every time we pick investment and then clients like, oh, how does this one perform? Oh, I like this one. How you mean I can get up to 20 something percent? They're like, I never knew such a place existed. I said, you never knew, now you know. You see? But in whole life, it's not like that. So that is the flexibility with universal life. And there's also daily interest account option. Um, like when it comes to universal life, I don't put my clients' investment into daily interest account. That doesn't yield much. You understand? And I tell my clients that, you see, the thing with universal life is that you can go aggressive on it because you are not looking for today's benefit. And any investment, I tell people, once you have a time horizon of 5 years and above, don't worry, go aggressive. If it doesn't balance the first year, it will balance the second year. If it doesn't balance the second year, at least by the time you take your average over 5 years, you'll just be fine. You understand? At least we have those historical data that helps us. Anyway, so we'll move on to, I told you, daily interest account. That is my personal view, Sha. You understand? It depends on any other broker might have their own this thing. Now, I'm saying with respect to universal life, okay? But when it's other investment like RRSP, TFSA, first time home buyers, of course, I look into daily interest account, okay? Because this one is good because you meet some people say, I don't want to lose one couple of my money. Okay, we must go conservatives then. All right. So let's move on to guaranteed investment account, GIA. Okay. So these are different investment options. Okay. So there's daily interest account, guaranteed investment account. Okay. Guaranteed investment account is like equivalent of GIC in the bank. We, the life broker, don't deal GIC, but we have GIA. Okay, so you can go ahead. Then we have index funds investment. When you start seeing funds like the investment, that is, an index fund investment earns interest based on return from a chosen index. Okay, so We have index fund, we have mutual funds. Okay. Then we move on to policy illustration. All those investment choices and options, you can read them. And they are just pretty much straightforward. Okay. Then we move on to policy illustrations. Now, these policy illustrations, again, this week, you see, there are how many of you on this call? Book appointment. Now, you may say, okay, I don't know, how do I talk to somebody? You know what? I'm going to put a guide, okay, in our Telegram group for you guys to use to ask people to give you 30 to 40 minutes of their time, so I can help you guys talk to them and then show you guys, okay? Show you guys how this thing works, okay? Because these illustrations, how do I explain components of illustrations, life insurance illustrations, whereby if I sit down with you guys and we run the illustration, everything will come to light. You see the illustration components, all this cash value, all these things, we're going to see it all in there, okay? Then talk about accumulated funds, the investment funds, accumulating funds, UL policy provides. You see, you're going to see all that. Then we surrendering the policy. What happens when you surrender your universal life policy? Okay, we talked briefly, we discussed policies, surrendering options this morning with universal life. Again, this is surrendering the policy with UL. So I want you guys to read this, okay? So this one is straightforward, okay? Premium offset option. So that is an option that we have when it comes to surrendering a policy. Basically, surrendering a policy basically is like putting an end to this policy, like you don't need it again and stuff like that. Then move on to policy loan. A loan is typically limited to 50 to 90% of the cash value. Okay, again, this is straightforward. Collateral, you see, for the third party. Now, there are difference between policy loan and then collateralizing your policy. What are those differences? So pay attention to these differences. You see, because one of this thing is that when you are taking a policy loan, okay, interest are charged on that loan, okay. Benefit of taking out, so tax may apply since a policy loan is considered to be a taxable disposition. You see that? So that is one of the things that you need to look into, and that is what makes collateralizing your card value the better option, because you may end up paying tax by taking policy loan, right? The benefit of taking a policy loan rather than withdrawing money from the policy is that funds continue to grow tax-free, all right? But when it comes to collateralizing your policy, yeah, collateral for third-party loan, see, this cash value of the investment account can be used as collateral for a loan from a third party, such as financial institution. Okay, and the financial institution is assured its loan will be paid by the policy. Now, taking a loan from the financial institution instead of directly from directly from the policy avoids any um um I can't even say what is up here. Something about tax. Okay, avoid any possibility of tax. So depending on how the loan is structured, principal and interest payments may not be required, and the loan and accumulated interest will be paid upon the death of the life insured by the death benefit, with the residual death benefit going to the beneficiary. All right, so you could see that there. And then at the end of the first year of the loan, okay, this is just an example, okay? Then we have leveraging. Then we have distribution upon death, and then look at under the level death benefit, what happened, and then the table is here for you guys to go through it. Again, all this particular section is straightforward. That is why I don't want to take too much time on it. And that brings us to the end of chapter 4. All right. So we'll move on to riders that provides additional benefits upon death. All right. So we'll take a bathroom and coffee break. Let me stop. I have good news for you guys. Chapter 5 is a very, very small, tiny.
You said good news. You can close the deal. Start with this.
But we still have chapter 6.
The issue for me is because all of these chapters, and we literally still have another class tomorrow morning. So
Okay, yeah. So maybe we'll just finish chapter 5 and then we stop there for tonight. Okay.
fabulous, fantastic. He's still up early. Yeah, thank you.
Yeah, I know. Okay. Let's go into riders that provides additional benefit. Okay. Now, the way I typically explain riders, excuse me, um, to our class, to our students is that look at riders like a toppings on a pizza. Okay. So riders on its own, when you go buy pizza, they'll ask you what toppings do you want? You want the pepperoni, cheese, veggies, blah, blah, blah. All those toppings, they don't stand alone on their own. They will need a
Okay.
pizza to stay on. Am I right?
Okay. Sure.
So those are your riders for you. Riders are like add-on, an upgrade to your insurance contract. Okay. So with that out the gate, the additional benefit upon death. You see, the following riders increases the death benefit. That doesn't mean you cannot have your policy, your contract without them. But when you have them, the paid up addition rider. You see, this rider again, you need to buy the right to exercise them, right? So if you go to buy pizza and you don't want any additional toppings, what you get is the bare bone basic ones, right? If the basic, whatever they have for their basic pizza is what you get. But this one now, paid up addition rider, when you add this on, then it means that you can exercise this right. And you also have insurance rider, accidental death rider, and then guaranteed insurability rider. Okay. So we are going to start looking into them in detail one by one. Paid up addition rider. A paid up addition were introduced in chapter 2 in regards to participating whole life. Yeah, you guys remember that, right?
Yeah.
The participating whole life, right? The paid up additional rider gives a policyholder the ability to pay up an additional lump sum policy. What this basically explains is that this rider gives you the ability, let's say you have 500K policy now, and you want to pay additional, 20K paid up addition. So this 20K is not going to be paid every month, but paid up. You
One
see,
time.
just like the name, paid up addition. So this additional coverage is fully paid up. That's basically what that means. Okay. It can be
Okay.
purchased by whole life or universal life policy holders. Now, paid up addition rider is underwritten at the same time as the base policy. So no additional evidence of insurability is required. Okay.
Okay.
Now, paid up addition themselves are restricted to specified minimum insurance and dividend options. So the paid up addition rider gives the policyholder the ability to pay an additional loan. Okay. Oh, sorry. Okay. And then the payout rider gives, I thought the thing
Yeah,
was
that's where
moving.
you are.
Okay. So for where am I now? Okay. Okay. For example, this is an example of a paid-up addition. See, for example, the minimum paid-up addition that could be bought might be 500 to a specified maximum number in any year. For example, a maximum of 2 could be bought in a year. Okay. So now to a policy lifetime maximum, for example, see the total number of paid-up addition over the lifetime of the policy could be bought in 10 kind of rights to be exercised in 10 different editions. Okay. Now, some of these policies could have a limited date or to a purchase date, and that example can be seen with this one. For example, can be made on a policy's anniversary. Okay. So this policy or by a maximum age, so where a paid-up addition can be bought, to a specified maximum age of the policy holder. Okay. So that is a straightforward one. You see, there is never a requirement for the policy holder who has added a paid-up addition rider to his policy to buy a paid-up addition. But if he does not do so, he cannot carry forward unused paid-up addition purchase right to the future years. Okay, so this is a important uh, um, statement for us to consider, because they will likely ask a question regarding this, that this person have a paid-up addiction right, and then he had problem, he had this and that, and then for some reason he did not exercise. Now they will come and tell you, will this person ask around whether paid-up addiction right that can be carried forward? No, cannot be carried forward. That is what this is talking about to the future, yes. So why add a paid-up addition rider? Well, the policyholder is able to increase the death benefit and cash surrender value of his or her policy with each paid-up addition that he or she is able to exercise. Such a rider, such a rider is beneficial for individuals who expect that their insurance needs will increase over time. For example, if somebody is young, maybe they just newly married, they've taken a policy, they plan on having children. So having this in their back pocket to exercise if they need it. Maybe they might say, okay, at any additional child that they have in their family, they'll exercise this right. You understand? So, which is a good thing to have, right? Now, the additional insurance is permanent, and it will be paid on the death of the life insured. Okay, we can see that example here. All right. Now, the next one is term insurance rider. So these are different riders, right? We've talked about paid up addition rider. So the next one now is term insurance rider. You see, like we saw this morning, again, you see, try and watch this morning class, because there we broke down term insurance. In fact, we scattered term insurance, dissect it. So you want to go back and bring yourself up to speed. But this rider, okay, the term rider adds additional insurance coverage to an insurance policy for a limited period of time. The death benefit of the policy with a term rider is the death benefit of the policy plus the death benefit of the rider during the specified time period. Okay, there are 4 types of term insurance rider discussed below. Each one increases the death benefit on a term or permanent life policy for a specified period of time. Okay, so the death benefit of the rider may be the same as the base policy or larger. Okay, so now this is a term insurance rider. So now term insurance rider, remember at the beginning when we started this universal life, I told you that is the policy, the only policy that gives us the flexibility to combine, to blend, to combo, to layer. You see, this universal life is where we can have term insurance, universal life, critical illness. Now, this term insurance rider, the way it works is this. Let's say I did a needs analysis for a client, and this client needs 500,000 coverage. But when we quote, maybe we do UL of 500, the premium this client cannot afford. Let's say this is a 37-year-old male, right? Perhaps the premium is 250, universal life. It was too much for this client. So the next option of options I showed the client is, okay, out of this 500, what is your budget? Client may say, I can do $100. I say, wow, that's really low. So what we can do in that case, because this client needs to be covered for 500. Anything less than that, he or she will be underinsured. And if anything happens to her, me as a broker, I have not done my due diligence of doing proper needs analysis. So what way can we protect this client with 500 and at the same time be able to fit into her budget? So one of those ways is, out of this 500 coverage, I will make 200K UL, 300K term 20. Why? Because during my needs analysis of the client has a house. She bought it 5 years ago. Amortization period now is down to 20 years. So I've put 200K. Then I may put CI 20K there. And then that might brings me to $115. Then I say, Mrs. Client, I'm able to build this for you. You are still covered for 500,000 for the next 20 years. However, after 20 years, this 300 term is going to fall off. And then you have 200,000 for life, plus your critical illness. However, if anything happens for you in the next 20 years, the beneficiary will receive 500. But if anything happens to you after the 20 years, your beneficiary will receive 200,000 plus your cash value. Do you guys see how we layer that together? Yeah?
We see
Yeah?
that.
Yes, we
Yes.
see it.
Okay. So that is how the term insurance rider works. Okay. Again, this thing, I cannot, especially, you see this chapter 4 and this chapter 5 is best experienced in demonstration. Okay. When I was studying for my exam, I didn't have anybody telling me all this. So after I get my license, when I started running illustration, then when I hear ACB, it was such a ACB, this and that. I have to calculate, accumulated cash. They appear so worded. So what? When I now run it, I say, oh my God, is it this thing every day now? So when I'm telling you guys this, you will do yourself a whole lot of great help if you start doing your field training alongside with this class, alongside with this your exams. So that apart from that, by the time your license drops, you are done with field training, you are killing it yourself. You are driving the show. You get what I'm saying? Anyways, so that is term insurance rider for you, okay? And then we see benefits of adding term insurance rider. Without even reading this text, unmute yourself. And what I've explained to you, what do you think is the benefit of adding term insurance rider?
It gives you the opportunity to take advantage of other benefits. It's not just the major factor. Like you can take benefits of other things
No,
outside
I
just
mean
having basic.
insurance rider. I just explain it to you guys now in the way I do it. So there's a key stuff there I'm looking for.
I guess you can also you're able to offer your clients different opportunities and advantages. I'm thinking.
Yeah. Proper
Yes.
coverage, adequate coverage. Do you understand?
Taking
That
in
fit.
different factors. So you're
Sorry?
almost like you're covering them 360. If you put this, even in the event of that, you are still covered, you still have this, you still have that. But my
Mhm.
my question or my not concern, what I'm noticing from the insurance and the part is like, is in your best interest to die quickly. Your
No,
beneficiary be like, why and if you die in 20 years, 500, if you are not dying in 30 years, what's going on here? You don't want to go
but,
to heaven.
but, but the thing is that if if you die, but again, okay, if you want to buy keep a permanent one, then the person will
Mhm.
have to pay 250, and this person doesn't have 250. But we want this person to be fully covered, fully
Coverage, okay.
proved, fully insurance risk proved, financial risk proved in event that anything happens. So it's not about praying to this thing, but it's about having something. It's better you have something you don't need
And
than
nothing, yeah.
and you don't have. Okay.
Gotcha.
Mhm. So, on the permanent policies, the term rider added to the permanent policy can, you see, accommodate short-term needs, while the permanent-based policy provide lifetime coverage. Exactly. Well, this we've talked about, okay? And we'll see that in this example. Then we go into family coverage
Family
rider.
coverage rider.
Yeah, so this is a third one now. We looked at paid up addition, term insurance rider, and then this is family coverage rider. So this family coverage provides life insurance for spouse and children, okay, and is available in units. So this is like where we are able to add children as rider to their own parents' policy, okay.
Okay.
Sometimes, but the thing with children's policy rider is that there's a limit to how much, and they are not
Uh,
usually, what I encourage parents to do is do you well for your children. Let them have their own. In 30 years, it's fully paid, and your children are covered maybe with 300 or 500 for life, paying less than $100, some $50, some $60. We came as an adult, we are paying through our nose for this insurance. Must our children suffer the same fate?
so even in that sphere, even doing this governments, that whole thing where the government pays is it 20%.
That
It will
one
even
is
make more sense for you to do UL than do that. If you just set
no,
up each of the kids.
no,
No?
no, 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 no,
That one
no,
has
no,
ESP.
no. You see, that's another thing again that some people do. And you see the kids' education savings plan for children, right?
Mhm.
It should be done. Imagine government say they are giving you 20% right off the back, risk-free. There's no investment that give you 20% risk-free, guaranteed. No, you
So
feel
with the
me? So
cost
you understand what I'm
or with the
saying?
cost of living. But if you had to choose that and a UL for the child, what would it be?
It will be
300K at
RESP.
21, and that one, pata pata, can it be up to 100K? Can it? At
What?
age 15? Can it be up to 100,000 by the time they get to the age where they can get it out? I don't think
No,
so.
you
What's the
see,
math?
the objectives are different. Okay? For the kids' education, the maximum year you can contribute for them is the December of the year the child turns 17. And the maximum you can put for each child every year is 2.5. Now, if you maximize this 255 and you feel you still have some extra money, then you put it in a UL for the child. For my children, maximize their RESP every year, and then we still have universal life for each of them.
Yeah, one in plenty. Because that's a lot. That's a lot with
Ask me that
with
question.
cost of living. That's a lot of money. But anyway, we digress. Moving on.
So let's get this out of the way. All right. So that is a cap coverage rider is the ability to be able to add your children on the base coverage. Okay. So again, with the children's rider, there are different this thing we can look into and read it is pretty much straightforward. Okay. Then we move on to accidental death benefit rider. Okay. An accidental death rider increases the death benefit when death occurs as a result of an accident. Eh, this one is so funny because it gets so okay. This one is accidental death. So accidental death is an unexpected death. So now, and this accidental death, if the person dies and it's not through accidental death, so this will not pay. Okay. The rider is offered in units like the family coverage rider or in multiples of the benefits. Okay. The two times of death benefit is a common amount of coverage. All right. Now, the rider has age limitation, even though the base policy is not subject to same limitations. So these are pretty much this thing. So an accident is considered to be an unexpected, violent, or traumatic event. Death resulting from suicide, self-injuries, war, or a commission of crime is typically excluded from accidental death.
So
Okay,
war
that
is not a
is
traumatic incident, really.
so
Oh.
that's what they
But
explain
in the
here now.
suicide, they're like if once is the policy is above 2 years, suicide doesn't
So
count.
that's
Why they
exclusion clauses and suicide exclusions.
mm-hmm.
Yeah, so we have a contestability period and suicide exclusions. Is that the one you are talking about?
Yes. I
Yeah,
think
so
that
those
one is
ones are
based on conversion. If you're
no, that one is
converting.
that's two different concepts, right? So that one is applicable to every policy. There's always contestability period and suicide exclusion of 2 years to every policy. But this one is accidental death is
Mm.
considered to be an unexpected, violent, or traumatic event, right? So death
Okay.
resulting from suicide, self-injuries, war, or commission of crime is typically excluded from the accidental death rider. Okay?
Yeah. Gotcha.
All right. So there's an example here, so you guys could read it, and then it will drive home the point better. Then we have guaranteed insurability benefit. So this guaranteed insurability benefit, this ensures that you can always, increase your insurance. You see, the GIB rider provides an option to increase coverage in future without having to prove insurability. So it is very useful for those who currently do not have large insurance needs. Okay? So and everything on guaranteed insurability benefit is. Then we move on to supplementary benefits. Okay, so the supplementary benefit could be accelerated death benefit, accidental dismemberment. You see, this accidental dismemberment is, you see, yeah, somebody does not die, but lost a body part. So each body part have its own price tag. So if somebody
Mm.
lose one arm, you get that amount. You lose one side, there's an amount. You lose both sides, there's an amount. You lose two arms or two legs, there's a breaking down of an amount that And this one is typically good for maybe people that works in factories or that operate machines and that could be exposed to some of
Exposed.
those accidents and stuff like that. And then there's what we call waiver of premium for total disability benefit. So this is also an supplementary benefit that one can, subscribe to. So this waiver of premium or for total disability is that when somebody is disabled and they're not able to work again, so this waiver of premium kicks in and start paying their premiums for them. Okay, so that
Makes
is
sense.
that one. Then we have terminal illness benefit. See, we have terminal, and we also have critical illness as well. So this terminal illness, we can do that. And then heart disease benefit. So I talked about CI, right? So again, so this one, we don't need to spend too much on them. It's very much straightforward. You see, just an add-on, topping, things you can, add to your policy. So they are just easy peasy. Okay. Then we
Very
have
true.
accidental dismemberment benefit. That's the one I talked about. There's percentage, there's a great a price tag, so to speak, in a layman terms on what the
Mm.
person gets due to a loss of any body part. Okay, so this table is a sample of accidental death and dismemberment schedule of loss. You see, so if accidental death result in death, 100% a benefit is paid. Both hands and both legs 100, entire sight of both eyes 100. Now speed and hearing in both ears. Then if it's one arm or one leg is 75%. You see like
Mm.
that, right?
Mm.
Thumb and index finger. So yeah. And then
Interesting.
waiver of premium for total disability benefit. Yes, I spoke about this one,
Yeah.
whereby when somebody is disabled and they're not able to work again, so this rider kicks in and start paying their premium. Okay. Then parents and payer waiver benefit. So parents and payer, this is a situation whereby as a parent, for example, now our children have policy, right? And we are the one paying for the policy. Okay.
Mhm.
Now, if anything happens to the parents, what do you guys think will happen to the policy? Because these children are children and they don't even have any
Mhm.
means of their own to pay, right?
Mhm.
So what some parents does, in order to secure the future of their children and in order to protect this policy from collapsing, they will take
Mhm.
what they call parent/payer waiver of benefit or waiver benefit. Okay, parent waiver benefit is used when a life insured is a child of the policy owner, and then the payer waive the benefit is used when the life insured is anyone other than the child, and then both benefits can be waived premium if the policyholder is totally disabled or dies. So what this means is that, so for these parents now, if anything happens to them, then the children will get coverage, but they won't have to worry about paying the premium again. Make
Okay.
sense?
Okay.
The example is here for you guys to read.
Okay. There's an
Then
example.
have, eh?
I'm
Yes,
listening
there's
to you. You
an
said there's an example. I was trying to. Okay, got it.
Yeah. So then there's cost of insurance. Premium for the base policy will reflect additional cost for the additional riders and benefits, then value of coverage. Okay. So the policy holder or beneficiary must need the insurance acquired via the rider or benefit for it to add value to the base policy. Okay. The value, and then the riders and the benefits are a way to structure coverage. All right. Then we can see that in this example. Then we move on to limitations and exclusions. All right. Note the restrictions in many of the riders and what conditions or circumstances triggers payment of benefit, such as the many limitations applied to paid up addition purchases. Now, exclusions. Now, when it comes to exclusions, certain events may exclude payment of the rider or benefit, such as a health condition not covered in the critical illness benefits. Okay, so this one now, for example, if somebody take critical illness, now when I start taking you guys out on a field trip, you're going to see that critical illness, we have the basic CI and the enhanced CI. The basic CI covers only 3 illness: heart attack, stroke, and cancer. So if somebody go and take this rider for only three, and then the person died through accident, nothing would be paid. Or the person get a flu and passes away, that rider would not pay. But that doesn't mean the death
Mm-hmm.
benefit will not pay. Okay, so we need to understand that the fact that rider did not pay doesn't mean the main pizza
Mm-hmm.
base will not be eaten. You get what I'm saying?
Got
Mm-hmm.
you.
Yeah. So that's part of the exclusion that we need to put into consideration. So, however, the death benefit provided by life insurance operates the same way across insurance companies. So if the life insured dies, the death benefit is paid, less any outstanding policy loans or whatever. Okay. So then there's a table here for us to look at, advantages, okay, and disadvantage of riders and supplementary benefits. So again, I recommend you guys go through these advantages and that
Ah,
brings us
Father. So
to 5.
exhausted.
Oh my
That's
goodness.
5 hours of lecture.
Anyways,
Good job,
so
good job. You're doing great.
thank you.